Wall Street is getting nervous about what's happening in the economy, and you're seeing the impact of that on the stock market because it's been a pretty choppy 2025 for stocks and investors, but most people don't understand why. And that's what I want to break down in this video because there are three things happening at the same time that are layering on top of one another. That is, number one, inflation has been moving upwards, not downwards, which is leading to number two, the Federal Reserve Bank being less aggressive with cutting interest rates in 2025, or at least they say, which is leading to number three, more defaults happening in 2025. So let me break this all down that we understand what's going on, starting with what's going on with inflation. Back in September of 2024, a lot of people thought that the inflation fight was over because we got the reading which said inflation had fallen to 2.4%. Remember, the Federal Reserve Bank wants to see 2% inflation, so 2.4% inflation was almost there and everybody started cheering. But then came October, and we got the reading that inflation went up, not down. Inflation went up to 2.6%, and everybody said it's a little bump in the road. But then came November, and it said that inflation went up again, now to 2.7%, and more people started to get concerned. We're gonna get the December inflation number in the coming days, but these high inflation readings got Wall Street a little bit more concerned, it got the government more concerned, and it got the Federal Reserve Bank more concerned, and that's why the Federal Reserve Bank then said that they plan to be less aggressive with cutting interest rates in 2025. The Federal Reserve Bank has said right now that they're planning on only cutting interest rates twice in 2025, which is not what Wall Street wanted. Wall Street was hoping for a number of more aggressive interest rate cuts in 2025 because more aggressive interest rate cuts would give investors, would give institutions, would give hedge funds access to more and cheaper debt, which they could invest into companies and which they could dump back into the stock market, which would hopefully help boost stock values even more. But now with the Federal Reserve Bank saying maybe inflation is still a problem, maybe we shouldn't cut interest rates, Wall Street is saying, oh, what is that going to mean for stock values? But then we have the third layer, which is something you definitely want to pay attention to now, which are rising credit defaults. Now, if you're subscribed to Market Briefs, you've already kind of been kept in the loop on this. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. It's completely free. It's a lot of fun to read, and we break down everything you need to know about what's happening in the markets, and it's delivered right into your inbox. We have hundreds of thousands of investors that are reading Market Briefs every morning. So if you'd like to join, I have the link for you down in the description below. But when it comes to credit defaults, there are three different types of credit defaults that Wall Street is starting to get more concerned about. One are consumer defaults, two are corporate defaults, and three are commercial real estate defaults. So let me break it all down. Starting with consumer defaults. Financial Times just published an article in the beginning part of 2025, which says that according to the data, credit card defaults are now at the highest levels that we have seen since 2010. Since the great financial crisis, that's where some people are saying, maybe we have a problem. In fact, here's what Moody's said to Financial Times in regards to the rising credit card defaults. Quote, high-income households are fine, but the bottom third of United States consumers are tapped out. Their savings rates are now at zero. So what is Moody's saying? Now, Moody's is one of the big credit rating agencies in the United States, and what they're saying is the rich Americans are doing fine. They have seen stock values, real estate values, investment values rise, so they're still okay and they're able to spend based off of their wealth because asset prices have boomed over the last 5 years. But if we take a look at the bottom third of Americans who are trying to survive based off of their salaries, well, salaries have not kept up with inflation. And so what do? Well, they turn to things like credit cards and other forms of debt. Well, those interest rates have also gone up. And so now not only do they have a lot of debt, but the interest rates have also gone up. So they are struggling making those payments, which is why we're seeing credit card defaults at the highest levels since 2010, which might be a problem. Then you have the second layer of concerns of defaults, which has to do with commercial real estate loans. Because there are about $1.8 trillion of commercial real estate loans, which are set to mature by the end of 2026, according to TREP, and this is from the Urban Land Institute. Why does that matter? Because unlike when you buy a house where you can get a 30-year fixed rate mortgage, if you're gonna go and invest in, say, a big office building, you don't get a 30-year fixed rate mortgage. You're generally getting a 3-year, a 5-year, maybe a 7-year adjustable mortgage. So you have a lot of people, a lot of real estate investors that either bought real estate or refinanced their debt in 2020, 2021, maybe 2022. And so now all those people that bought properties or refinanced their debts in the early 2020s are now starting to think about what's going to happen when their debts readjust. Because again, they're readjusting mortgages. And back in 2020 and 2021, you could get a mortgage for 2.5%, 3.5%, 4%. Today, it's almost double that. So you can start to see why a lot of commercial landlords are starting to get concerned, because that mean that their expenses would go up. Not to mention, corporations are facing the same problem. Corporations also don't get 30-year fixed rate mortgages, they get readjusting debts. And every corporation that has debt was readjusting, meaning refinancing as much debt as possible in 2020 and 2021 because you could borrow money at the lowest interest rates in the history of time. So you had a lot of corporations that not only were refinancing their debts, but they were pulling out as much cash as possible at 3 or 4% interest rates. And now we're wondering what that debt is going to readjust to in 2025 or 2026. Now, this begs the question, why are interest rates going up despite the fact that the Federal Reserve Bank has been cutting interest rates? Which ties into what I was talking about a little bit earlier in this video. Because remember, the Federal Reserve Bank, which is the central bank here in the United States, actually cut interest rates in 2024. And they're planning on cutting interest rates again in 2025. And so if they're cutting interest rates, you would think that mortgage rates would be going down, credit card rates would be going down, real estate investment loan rates would be going down, and corporate debt rates would be going down. But it's actually the opposite. If you've been shopping around for a mortgage or a car loan, you might have seen that mortgage rates and car loan rates and credit card APR rates and all other types of loans have actually been going up instead of down. And the reason why has to do with the concerns about inflation along with the Federal Reserve Bank. So let me explain that for just 60 seconds. There's been a lot of concerns about inflation. There's been more concerns about the national debt. This has caused treasury yields to rise. A treasury is a loan to the government. And when people are concerned about inflation, when people are concerned about the dollar, people aren't as likely, they aren't as willing to lend their money to the government. But the government still needs your money. And so if there's less people lending money to the government needs to incentivize you to lend your money to the government. How do they do that? By raising interest rates. So what we saw over the last few months is that the treasury yields have been rising, meaning the government is now paying out higher interest rates to investors. I mean, it could be regular people, you and me, it could be corporations, it could be the Federal Reserve Bank, it could be foreign governments that are lending money to the government. But the United States government is now paying out a higher interest rate on that debt in order to incentivize people to keep lending money to the government. And we all know that the government keeps needing more and more money. So now that the government has to pay out these higher interest rates, that has also pushed up mortgage rates, credit card rates, car loan rates, corporate debt rates, and commercial real estate rates. And now we have some people that are on readjusting loan rates. For example, credit card debt is generally not a fixed rate debt. It's generally a readjusting rate. Commercial real estate debt is generally a readjusting loan. Corporate debt is generally a readjusting loan. So now when you have these entities that have these readjusting rates at a time where inflation is still high, people are starting to get concerned about the economy. I know it's been going on for years now. People have been concerned about the economy, but we are starting to see more and more lower income or people that don't have access to a lot of assets, people that are struggling more and more, that are saving less and less money, like what Moody's says, their savings rates are at zero. We're seeing more and more people that are essentially walking the edge. That's a concern. And so if now we're walking this tightrope and something bad were to happen, you can start to see where the problem is. We're already seeing credit card default rates rise. That's not good for credit card companies. It's not good for people. But you have to wonder what's going to continue to happen in 2025, because if we continue to see more defaults, what does that mean? Well, if we focus on consumer defaults, that means that people don't have money to keep spending on the credit card. So maybe people can't keep eating out. They can't keep eating at Chipotle. Maybe that means they're stopping buying at Gucci. That also means that the credit card companies could get hurt if they have to keep filing big losses. So there are concerns with defaults happening on the consumer side, but then you also have the concerns of defaults happening on the corporate side. If we see more commercial real estate defaults, obviously that would hurt banks, could also hurt asset values, real estate values. If we see more corporations concerned with readjusting debts, that means that more corporations could see their expenses rise, not just because of inflation, but because their debt servicing costs rise. Right? If you're a business and you have to pay debt payments, well, that's one of your expenses. If all of a sudden your debt payments go up by 50%, your expenses just went up a lot. It's not like your inflation changed, but your debt costs went up, which means in order to service those higher debt costs, you're going to need more money, which means either you're going to have to sell more stuff or you're going to have to raise the prices of your things. Now, we already know how bad of an issue inflation is and has been, and so we know it's difficult for businesses to continue raising prices today because a lot of people just don't have the money to spend more money. It's not 2021 and 2022 where people had the money to spend and they were paying over asking price for everything because people were spending money willy-nilly and had the extra money to do it. That's not what it's like today. We're seeing more people become cost conscious, more people are becoming spending conscious. And so if that's what's happening in our economy today, it's going to be interesting to see what happens with corporations, especially now because we have a new president entering the White House very soon. Obviously, President-elect Trump has campaigned on how much he's going to strengthen the economy. So that's something that you bet he's going to be working on. What is he going to do? Well, we'll see what happens. We'll see what his proposals do. But these are the concerns that Wall Street is looking at right now. They're looking at what's happening today, where we have the concerns about inflation, we have the concerns about the Fed not cutting interest rates, and now we have concerns about debt defaults. Well, could the president come in and make things better? Sure. Could they make it worse? Maybe. We don't know what's going to happen. But that's one of the reasons now why we've been seeing such a choppy 2025, because we have all these concerns that keep popping up. But what's really interesting here is none of these concerns are actually new. They're just becoming now more surface level. People are starting to see the impacts of them. These are things that we've been talking about here on my YouTube channel and Market Briefs for a long time now. But they're starting to see more headlines, which is why we're starting to see more people get concerned about it. Now, your job isn't to be blindsided by this. Your job is not to panic. Your job is to be able to find the opportunity. And that opportunity is ultimately going to depend on your investing strategy and your investing goals. And this is where your financial education is so important, because if you're saying, well, Jaspreet, I'm just a passive investor. I just invest my money into the S&P 500. Should I be concerned? No. You keep doing what you're doing. You keep ABB, always be buying. You don't worry about any of this. If you're looking for more specific opportunities, if you're more of an active investor, well, now this can create opportunities for you. And this is where you want to pay attention to how you can find investment opportunities that will help you grow your portfolio. Again, it depends on your strategy. It depends on your goals. You can't just randomly do what a random person on the internet is doing. You should not blindly follow a random guy on YouTube, because your goals and your strategy are different than mine. Your goals and your strategies are different than everybody else. But I want you to understand what's happening, and I want you to be financially educated. That way you can find the opportunities and not panic. A lot of people hear the headlines, they freak out, and they say, oh, we're going to enter a recession and the world's going to end. That doesn't do you any good. You got to understand what's going on. That way you can find the opportunity, because while everybody else is panicking, you can find the opportunity and find a good investment. That's why your financial education is so important. And with that, I will see you on YouTube tomorrow.